What is double entry accounting? The system used for accounting is called double entry bookkeeping. Each transaction is entered twice into the ledger, one side a debit and the other a credit. This method was created to show that everything had been accounted for or was in balance. In the ledger books used prior to the computer age, there were two columns. The column on the left was called debit and the column on the right was credit. To be in balance, the total debits must equal the total credits. Pretty simple concept, but how does it work? There are 5 types of accounts in a general ledger as shown in this diagram. In production accounting, we use basically 3 of these: assets, liabilities, and expenses. Equity and revenue are on the studio or production company side, but we are not directly involved with these while working on the production side. The asset and liability accounts appear on the balance sheet. Expenses are all the costs associated with the project, like the cost of labor and fringe, cost of purchases and rentals, and so on, and these appear on the cost report. Under each account type in the diagram, it shows if this type of account is either increased or decreased by a debit or credit. Both assets and expenses are increased by a debit and decreased by a credit. Liabilities are decreased by a debit and increased by a credit. Transactions are coded into accounts to separate and organize entries in the general ledger. Using this example of a chart of accounts, the bank account, an asset, is account number 10101 and appears on the balance sheet. Accounts payable, a liability, is account 70200 and also appears on the balance sheet. Fuel is in account 35044 and is an example of an expense account, and expenses appear on the cost report. Placing transactions in specific categories allows us to more accurately track where costs occur and how they compare to the budget. Let's say the show receives $50,000 into the project bank account from the financier. This is recorded as a $50,000 debit to the bank account. We know that the bank account is an asset and that an asset is increased by a debit entry. So this shows the bank account has increased by $50,000. The other side of this transaction is a $50,000 credit to the loan or the amount funded by the financier. We know that a loan is a liability account and that a liability account is increased by a credit entry. Therefore, this shows that the amount of the loan, or rather the amount of funding provided by the financier, has also increased by $50,000. What happens when we pay payroll? This shows that we debit the specific wage account, which is an expense account, and is increased by a debit. Now mind you, each type of labor has its own unique account in the general ledger, meaning the account code for the costume designer is different from the account code for a lighting technician. This payment of wages comes from the bank account, which is an asset and is reduced by a credit. When the wages are paid, we credit the amount from the bank account, which reduces the amount of money we have in the bank. How does it work when we use a purchasing card? The customer buys clothing for the principal actors using their purchasing card. This is recorded as a debit to costume purchases, which is an expense account, and increased by a debit. The other side is a credit to the purchasing card account, which is a liability account, and increased by a credit. So then what happens when the purchasing card is paid? Can you tell me, what do you think are the accounts involved when that liability is paid? It all starts when Costumes buys the clothing, which is recorded as a debit to the expense account for costume purchases. The other side of that transaction is a credit to the liability account for purchasing cards. Then the invoice from the purchasing card provider arrives, and it is input for payment as a debit to the liability account purchasing card, which reduces the liability. The other side of that is the payment when a check is issued to pay the P-card provider, which is recorded as a credit to the bank account, which reduces the bank balance. Let's do this one more time. This time, the grip department rents equipment, which is a debit to the grip equipment account, and is offset by a credit to accounts payable, which is a liability account that shows invoices that need to be paid. Accounting inputs the invoice for the grip equipment into the accounting system, which is a debit to the accounts payable liability account. And a check is issued to the grip equipment provider, which is a credit to the bank account and reduces the bank balance. With computer systems, the second half of the transaction often happens automatically and is not obvious to the person doing the input. We just trust that the accounting system will lodge the other side of that entry. But it's important to be aware that it happens even if you don't see it on the reports that you review. Additionally, these are the building blocks to understanding how and why to prepare journal entries.